Hey, hello, welcome everybody to today's workshop. For those of you that are joining us, even though the Super Bowl might be starting, I appreciate you watching today. Today we're going to have some very important discussion, I believe. There is potentially some very large tax policy changes coming. So this is under the new President Biden. So we're going to talk about his potential tax policy changes. So nothing's set in stone yet. And so all we're really talking about today is what's potentially to come. But there are some things there that I do think are going to affect both high earners and low earners. So I wanted to bring this workshop to you today so that you can have an idea of what to expect, how to prepare potentially, and if things are done retroactively, which I don't think they will, but at least you know what to be thinking about. And also for those of you that are potentially going to be leaving an inheritance, or can start thinking ahead a little bit more so that you are better prepared if you were to leave something. Hopefully a very long time in the future, but just so that you know what to do now and in the future as these things come into play. So without further ado, my goal is to get this done before Super Bowl starts today. So we're going to jump right in. And if you have any questions, as always, please leave those in the comments and I'll do my best to answer those. And if you're watching this at a later time, if you can please like, share this video, please follow my page or subscribe so you can get notified of all the updates. I'd appreciate that. Every Sunday about 2 p.m. we're going to be bringing you a workshop based on something having to do with retirement planning to make sure that you are better prepared and hopefully save some money and have a better retirement experience overall. So for those that don't know me, if you're new here in the group, my name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning. We really specialize in helping people plan for that retirement and then also helping them with things like retirement income planning after they've retired, helping them with distributions, making sure they're really managing that tax journey, right? So after you retire, you're going to, and before you retire, but you're going to be on a tax journey where each year you're going to need to decide, where do we put money in each bucket to save? Where do we take money out of each bucket to fund a retirement? And so each year, those things are going to be changing and developing and possibly flipping completely around. So we're talking a little bit about that today. But if you completely thought you knew exactly where to put your money for each year going into retirement, like if you're putting all your money in a Roth IRA or all your money pre-tax, there's going to be a big flip potentially with this Biden plan. So we're going to walk you through some of that. So hopefully you enjoy this, and I'm open to any feedback. So if I appreciate if you would leave me any comments below, if there's something else you want to learn about, or if there's anything I did not explain well, I'm happy to jump in and try to do my best to update that. So without further ado, let's jump in today. So we're going to talk about Biden's tax plan and the proposed changes to tax policy. As always, I have to let you know that this is for educational purposes. Don't take anything I say to be 100% designed for you. This should be used as a guide to help you make better decisions. It is not tax, legal, or specific financial advice, okay? But hopefully it will be good. Okay, so what's the background of Biden's tax proposal? So President Joe Biden intends to challenge many aspects of the current system in efforts to raise tax revenue. Okay, so we're going to be talking about this over the next few weeks because this is a very unique time. Okay, when you look at the amount of debt to GDP, we are getting back to, when you talk about the equivalent level, is very similar to post-World War II as we are going into now another potential tax plan that's going to be dropping additional $1.9 trillion of dollars that are just printed out of nowhere, basically. Okay, this is not money that we have. It's all borrowed money that's going to be printed. We've already done about 4 to 6 trillion, depending how you look at it. So there's going to be some things here that we either need to pay it back one way, and it's either through increased taxes or it's going to be through inflation. Okay, so for those of you that are living on fixed incomes, a lot of annuities, or expecting to live on a lot of annuities, or just a general fixed income, inflation is going to be something that we really need to think about and have a plan for, because the value of your dollars and the values of those guaranteed payments are most likely going to go down over the next 10 to 15 years. So the front door, as we say, is raising tax revenue. The back door is inflation. So Joe Biden is talking about raising tax revenue in this potential tax plan. The tax plan would enact several policies that would raise taxes on individuals with income above $400,000. The tax plan would raise on corporations by raising the corporate income tax rate and imposing a corporate minimum book tax. So corporations are most likely going to see higher taxes. And even if you don't own a corporation, when it comes to corporations getting their taxes increased, this generally leads to a little bit slower growth after this is the case. So in 2022, we are expecting slower growth, at least in the U.S. market. So this is something to be thinking about as you're looking at your investment portfolio. And Biden's tax plan would raise tax revenue by $3.3 trillion over the next decade. I've talked about this before, that even though it's going to raise tax revenue, it potentially could also hurt our job growth and our economic growth as well. And it is actually expected to be a negative outcome. But if you are on the lower end of the income perspective or the income spectrum, there's a lot of good things in here that might actually really help you out. So this policy, there are some things in here that if you are in the lower income areas that could benefit you as well. So we're going to talk about those today. All right, so general tax policy themes. So the overall, current party in charge, the Democratic Party, has some general tax policy themes. One of the big one is additional payroll taxes on high earners. Okay, so that's a big one we'll talk about. They want to increase the marginal rate imposed on high-income individuals, increase the capital gains rate imposed on high-income individuals, and they generally want to tax the wealthy. And some various ideas include an annual wealth tax and greater estate and gift taxes. And they also want to increase the corporate income tax rate. There's also another tax that I'm very concerned about for most people in here, and that would be the step-up in basis getting eliminated. Okay, so when you pass on assets to your heirs, generally they receive them at the current value that they receive them at in the year of your death. That may not be the case anymore, and there may be some forced sales that could cause a lot of taxes to be coming in the future. So we'll talk about that towards the end. Okay, excuse me. Potential key changes of Biden's tax proposal. So tax increases on over $100,000 or $400,000 of income, the elimination of long-term capital gains preferential tax treatment for income over $1 million, elimination of the step-up in basis for capital assets upon death. So this could definitely even hurt our lower income. It's hard to say anything lower than $400,000 is low income. I wouldn't say that's the case, but this is for everybody. Okay, so this elimination of step-up in basis of capital assets upon death could impact pretty much everyone in this group that owns a home or has any sort of assets. Next one is a flat retirement contribution credit of 26%. So this is going to flip around, most likely, the normal idea of where you contribute to Roth or traditional type contributions for your retirement accounts. They're looking to do a 50% reduction of exclusion amount for estate and gift taxes, so essentially cutting the estate exclusion in half. And some other changes we're going to talk about are the child tax credit, that'll be increased. First-time home buyer credit, that could be a really big one for any of your younger folks or children or grandchildren. I assume most people in here are closer to retirement. Or if you haven't bought a home in the last 2 years, you could actually probably qualify for this as well. So that could be a big thing, and there's some other changes we'll talk about there too. Okay, so let's jump into talking about tax increases on income over $400,000. So what they want to do is restore the 39.6 marginal rate. So basically bring that back up quite a bit. And they want to expand the 12.4% Social Security tax. So if you didn't know, the way Social Security taxes works is you generally pay 6.2% for your contribution. Your employer actually has to pay the other 6.2%. If you are self-employed, then you actually are responsible for the full 12.4%. So they want to expand that. So they're going to have essentially a donut hole. We'll talk about that in just a moment. They want to cap itemized deduction tax benefits to 28%. And then there's some other changes, which is restoring the 3% P's limitation and adding a new Section 199 deduction phase out. The P's limitation really comes in for people that deduct a lot of expenses. So they'll talk about that. That's more for the much higher income folks. Okay, so what are these new tax brackets potentially going to look like? So if you can see on the left column here for 2020, you can see that if you are below $400,000, your top tax rate is 32%. And then from $400,000 to $600,000, your top tax rate will be 35.6%. And then above just over $600,000, it goes to 37%. Now they want to make a change that right at $400,000, you go right from 32 to 39.6. Okay. So that's going to be, that's a pretty significant increase for people above that range. They haven't really said, if this is going to be for, married filing jointly above 400,000 or single above 400,000. So that's not really clear yet, 100%. So you can have two high earners and easily be in the 39.6 bracket now and be paying quite a bit more tax. And a lot of things we'd want to do in normal financial planning would be to maybe add more to tax deductible accounts, like 401ks, for example, but we're going to lose some of that full deductibility, which we'll talk about shortly. Okay, the second thing is we're going to be looking at a Social Security tax. And as I mentioned, it's going to be what we call a donut hole. Okay, so essentially between what it is now, 0 to about 137,000, you pay your 6.2% normally, and after 137,000, you're not going to pay anything above that. Generally, it stops there. So a lot of you folks that are higher earners, somewhere during the year, you usually get some sort of raise. You get a bump, and so that number, that 6.2%, generally comes back to you after that point. And so a lot of times we'll try to use that for other things. But in this case, we're going to have a gap, or a donut hole between 137,000 and 400,000, where after 400,000, they want to again then implement that 6.2% Social Security tax, which is 12.4% for our self-employed individuals. So that could be quite a bit more tax depending on how much income you're making. And again, most people are not in this case. Over 400,000 of income for an individual is generally considered to be in the top 1% of income earners. And most people don't actually earn that amount every single year. A lot of times people earn that amount, and it's usually just in 1 year because they receive, let's say, a big stock grant of some sort that vests. Or they'll have just a really high income year. Or they'll have an event like they sold their business. And so in that one particular year, they make millions of dollars, but that's not what they're making every single year. So this can take a really big bite out of those sort of situations where you receive a big stock grant, or let's say you sell a business. Because again, most people don't stay in that 1%. They kind of go in and out. It's a fluctuating scale. Very few people actually stay in there consistently. Okay. Next thing we're going to talk about here is they want to cap the itemized deduction tax benefit at 28%. Okay. So the exact method is not clear, but below is an example of a $20,000 itemized deduction. Okay. So if you look at the top row there where it says current system tax value of deduction, it for a $20,000 deduction, if your top marginal tax rate is 22%, you would say $44,000. If you're in the 24% marginal tax bracket, you'd be getting a tax savings of $4,800. Did I say 44,000? I meant to say 4,400. $4,800. At 32%, you would get a deduction of $6,400. At 35%, it'd be $7,000. At 37%, it'd be $7,400. So if we have an increase in taxes, according to this new tax plan, there would be a lower value to that itemized deduction. So what we're looking at there is once you get past 24%, you can see that at 32%, it would go from $6,400 down to $5,600. At 35%, it would go from $7,000 down to $5,600, and at 37%, it would go from $7,400 down to $5,600 for that. And that's just at a 20% itemized deduction. That's a somewhat of a high itemized deduction, but not really. A lot of folks will have 30, 40, 50, and hundreds of thousands of dollars depending on that particular year. So this is a pretty significant hit to your pocketbook if you're somebody in this case. All right. The next thing here is they want to eliminate the long-term capital gains preferential tax treatment for income over $1 million. So if you are not familiar, if you have long-term capital gains, they receive a benefit of somewhere between 15% to 20%, which is the max capital gains rate, versus your normal tax rate. So this could be a pretty significant increase. So for folks that are making less than $1 million, which again, most people do not make $1 million every single year. Generally what happens is they have higher income earning years, or they sell a business, they sell some property, they do something where they have a high income year. And so this can really hurt if you're somebody who has, this happens to fall under the years where this tax plan is active. So as you can see here, if you go, above $1 million of income in that one particular year, you're going to go from the 20% long-term capital gains bracket to 39.6. So we're almost doubling that. So what generally happens is most people decide not to recognize income. They don't just decide to sell the businesses, or they'll move their income sources to other things like municipal bonds, for example, that would generate tax-free income at that point. So there's always, I shouldn't say always, but a lot of times there's ways around this kind of stuff. But this is something where they're definitely trying to come in and tax our high earners. So you're going to see a lot of athletes, which, if you think about today being Super Bowl, right? A lot of athletes, their average career is somewhere between 4 to 8 years in the NFL. So they're not going to be making this amount of money for the rest of their life. But all these tax increases, as you can see here, can really hurt somebody like that potentially could be in that higher level of income for just a very short amount of time. All right, so now we're going to talk about the tax eliminating long-term capital gains for income over $1 million. So this is a critically important fundamental shift, okay? We are not going to, the plan does not get rid of the 3.8% surtax on net investment income that would still apply as well. So the top tax rate paid on such long-term capital gains income today would be 20% for the long-term capital gains tax plus a 3.8% surtax for 23.8%. This proposal is going to nearly double that to 39.6% plus 3.8% for anybody who has over $1 million of income. They're going to see a 43.4% income tax rate. So this can be really, really painful for folks that are being in this range. So there's going to be a lot of, as they say, evil, wealthy people that are not going to be very happy about this. But what you have to remember, again, there's people that don't earn this income. And in general, on average, people don't earn this income every single year. And so this could really be bad if it happens to them in these particular years. And I like to use our football player example because they're not going to be earning that forever. With a very short career span, they could potentially be paying double taxes, and if they just happen to earn these in the same years that they're, a football player in the NFL, for example. Okay, so this next situation here, this is a big one. Okay, so this is what I want you to pay attention to for pretty much everybody. If you own a house, if you own stocks, if you own a 401k, if you own any sort of capital assets, they are proposing that we have an elimination of the step up in basis of capital assets upon death. So this could be really, really messy, okay? So the elimination of step up basis upon death. So this is probably the most significant proposal in the taxation of wealthy individuals. The proposal to eliminate the Section 1014A basis adjustment at the step up. Okay, so what this could possibly do is force whoever inherits your assets to sell those assets upon death. So this could be really bad. Okay, and think about in terms of maybe having like a family farm, for example, right? If you have a family farm, you obviously don't want to sell part of that to pay the taxes, but it could be worth $2+ million or maybe more. But a lot of family farms just don't have like a lot of cash available. So being able to inherit this upon death with no taxes due is a huge benefit for somebody like that. And also, if you are a real estate investor, for example, if you own, a lot of real estate properties that are, income producing properties, maybe you have mortgages on them, maybe you don't. But if you have a lot of properties that are going to get passed down to your children, well, there could be a possible forced sale of those assets to produce the income to pay the assets to pay the taxes. Because most people that have high levels of wealth, it's not generally just regular income sitting around. Okay, this is something actually really important that I want to talk about for a second. So most people that have high levels of assets don't generally just have money just sitting around in cash, okay? There's an example that was brought up recently that I heard that I thought was a good example. And again, you might hate these even rich people, but let's think about somebody like Mark Zuckerberg, for example, okay? If someone like him that owns a bunch of company stock, again, maybe this is not the best example, but if he owns a bunch of company stock, and they implement something like this, or even a wealth tax, they could be forced to sell off a huge portion of their company. Or if you own, let's say you own 10 or 20 real estate properties, you can be forced to sell off a big portion of your properties to cover those taxes that are due. Because most people I know that own a lot of real estate, they'll hold debt on them, for example. And so there's not a lot of equity per se, but there might be a lot of cash flow coming in. But that cash flow isn't necessarily just sitting there piling up, It's usually invested into other assets. So if you're forced to pay a big tax bill and you lose, let's say, a capital gains treatment or a step up in basis, and now you have to pay your normal tax rate, which who knows how much income it could be. And if we're looking at these new proposals, it could be over 50%. You could have to go back and pay the equivalent of whoever's basis that you inherited the property from. Okay, so another example. Let's say you're somebody who you have all these properties that you bought that are, maybe you bought them for $50,000 to $150,000 15, 20 years ago. And now those properties are worth $5, $6, $7, or $800,000. Normally, when you pass those on, you're going to get what's called a step up in basis to whoever inherits those properties. And so they don't necessarily have to pay tax on the whole value from the value you purchased this at, which could be $50,000 to $100,000, and maybe the basis is zero now because you depreciated the properties, over the years. They're going to have to pay tax on whatever the current value of the property is. So going back to what I was saying, this could cause a forced sale and could just be a very expensive and very messy treatment for anybody who owns any sort of asset. So, these are things, folks, that we really need to be thinking about as we are deciding who we put in the office, because this could be quite messy. So the other thing too is there could be lots of potential implementation issues as the beneficiary doesn't know the cost basis of the asset. So if your beneficiary has no idea of the cost basis and you haven't been tracking it appropriately, this could, again, be very, very messy. And not only could it cost a lot of money in taxes, it could cost a lot of money in actually implementing and paying for the services needed to do this. So, you're essentially saving all this money and passing on this wealth to have it, really taken away from you and ripped away by the cost of the transfer. So this could be really bad, and there's going to be a lot of planning that needs to go into that if you are somebody who is in that case. Okay. All right. Next discussion here. This one is very interesting. Okay. So a flat retirement contribution credit of 26%. So this is basically going to hurt the people that are making high incomes, and it's going to really help the people that are making low incomes, but it's probably going to flip around our strategy when it comes to where to put money as we are saving for retirement. So the intention of this proposal is to adjust the current system away from a world where the dollar benefit of retirement contributions is higher for higher income individuals. So this, for example here, if you're a high income earner and you're in that 39.6% tax bracket, if you were to save $10,000 into a traditional 401k, after this new proposal, you're only going to get a maximum 26% tax credit. So you're going to get $2,600 of savings, basically. Versus if in the current tax plan, you normally would get that full 39.6%. And so your tax liability would go from $3,960. Your current tax savings would go down from $3,960 down to $2,600 with this new proposal. So this is going to result in about $1,360 more tax liability, and then on top of that, this money is going to be in your traditional 401k, and you're going to have to pay tax again when this gets distributed from your 401k after age 59.5. So for high income earners, Roth accounts now may be a better benefit for you just to kind of eat it today and just take that 26% and then never have to pay tax again. So this is something that's going to be pretty rough for any of you high income earners. I'll talk about that more in just a few moments here. Okay. There is going to potentially be a 50% reduction of exclusion amount for estate and gift taxes. So this is something that it's not going to affect most people. I mean, just being honest with you, it's not going to affect most people because right now the current exclusion for estate and gift taxes is $11.58 million per person, so over about $23 million for a couple. Most people get nowhere near this, so it is going to affect a very small proportion of people, but it is cut in half. So in 2025, the exemptions were expected to revert back to the pre-TCJI law of $5 million in 2011 dollars. But Biden's proposal calls for an immediate halving of the current $11.58 million lifetime deduction amount that applies to both estate and gift tax. So again, this is a very small proportion of of people, so I'm not going to spend too much time on that. But it is a big one for if just a few years ago you're expecting that you can pay no tax on almost $23 million as a couple. Now that's going to get cut to 12. That's going to be a big tax bill, millions of dollars for people that are at that level. Okay, so here's some other changes that these are probably going to help a lot of folks that are on the lower income perspective. So there are some increases in the child tax credit. So they're working on getting the child tax credit increased from $2,000 for children under 17 to $3,600 for children under 6 and $3,000 for all children under 17. So that's a 50 to about 80% increase in tax credit right there. So that's a good one for low-income people. The child and dependent care credit, they're looking to move it from $3,000 to $8,000 for one child and from $6,000 to $16,000 for two or more. So that's a big one as well, again, for lower income people that need care for their children while they're working. This next one here, I think is going to be a huge benefit for a lot of people, especially if we do enter some sort of housing crisis. They want to bring back the first-time home buyer credit and reintroduce that as a refundable and advanceable credit of up to $15,000. So that can be huge. There is a lot of people right now that are sitting in forbearance. Okay, and then even worse. So this is something I want to talk about for a second. So there's a lot of people that are in forbearance in their primary homes, and more than likely there's going to be a lot of programs from the government to help you save your primary home. But for all these people that went to these seminars these last few years talking about get rich with passive income and buy properties and then rent them on Airbnb and have them pay off your home essentially. I think for a lot of those folks that got big mortgages that weren't necessarily sitting on a lot of cash that can ride out these storms, that currently have people that were not able to rent on Airbnb, or that may have renters that haven't paid for possibly 10 or 11 months at this point, and this is getting extended again all the way through, I think, September, October. So there's going to be a lot of renters that are going to owe $20,000, $30,000, $40,000 in rent that my opinion is that they're probably not going to have it. They're not going to be able to make that up and pay it. So I think a lot of landlords are going to be in a lot of trouble once this all opens up. So that first-time homebuyer credit might be kind of a saving grace to having our market completely melt down. A lot of folks in the millennial generation have basically been, renters essentially, and have not been able to ever purchase a home because the cost of housing has gone up so much, and then also the down payment amounts have just been out of reach for a lot of people. So this home buyer credit could be a huge benefit. So if you have a child, let's say, or a grandchild that is looking to buy a home sometime soon, you might want to recommend that they wait a little bit. Not only are they potentially going to get this home buyer credit, but also once the market, if it does turn, and things aren't quite as rosy as they are now, there might be an opportunity to pick up some properties, and especially from those folks that were trying to be the big Airbnb rental income property owners that are probably going to be facing a lot of trouble. I really think they're going to face a lot of trouble when this comes up. So if you have somebody looking to purchase a home, first-time home buyer type situation, you might want to have them wait and see what happens at least towards the end of the year or beginning of next year if this policy does go through, because not only is $15,000 a wonderful benefit towards the down payment, the home buyer credit, but there also might be some opportunities in the market for folks, for landlords that want to get rid of properties and don't want to have to go through the foreclosure process. And there was a lot of people in 2008 that did that, and they made deals with the banks to basically purchase the home from the for sale by owner directly from the owner, and just get that worked out through the bank. So again, opportunities, in every tragedy, there's opportunity, right? So as we hopefully get the economy open back up, the mortgage forbearance is going to have to stop at some point. So I really think you might want to consider waiting a little bit longer to purchase if you are somebody looking that could qualify for the first-time home buyer purchase. Okay. All right. And then the last bullet point here is a brand new proposed caregiver credit of $5,000 for informal long-term caregivers. So this could be a beautiful thing because, we've talked about this in the past as well, but about 70% of people need some sort of long-term care, okay? But only 55% of people end up paying, which leaves the other, paying for professional help, I should say, which leaves the other 15% usually getting taken care of by family members. So if you can get a caregiver credit of $5,000 to help out and take care of maybe your spouse or a family member, this could be something that helps out along the way because the cost of care has just gone up so much, and I think that might be helpful. So, all right. Now let's talk about some potential planning opportunities for high income earners related to that 39.6% tax bracket. Okay. So there is, again, this is estimated, but from what I'm hearing, there's about a 20% chance that this tax plan is going to get through and become retroactive for all of 2021, okay? So that means you have 2021 to look at some things for some tax planning before this all kicks in if you're a high-income earner. So one thing you might want to consider is to consider a Roth conversion to accelerate income in 2021 and to pay at our current lower tax brackets and pay taxes while they're on sale. Another thing you might want to consider is to consider harvesting gains from some sort of invested asset. This might be, if you're going to be in that place where instead of paying that 20% of capital gains rate, you're going to go to 39.6, on everything. You might want to consider harvesting gains this year and taking in some of those and putting those aside, and again, paying the taxes while they're on sale. And then another thing you might want to wait as well is to defer loss harvesting, okay? Because loss harvesting may be more valuable for you in the future while those tax rate is higher, okay? So, as a consumer, what I recommend, obviously I'm biased, okay? I'm going to be fully honest about my bias, but I do think you should consider an integrated tax and financial planning approach. And that's what we provide at our firm, right? We want to make sure we're bringing in tax planning and helping you manage your tax journey, not only just looking at only investments. And this is where you folks that are only working with people that only do investments, and maybe you're working with Vanguard that you pay 30 basis points or whatnot for your investments. But I know Vanguard doesn't do tax planning; they don't look at insurance planning and things like that. And so you might be really missing out here if you're somebody that's on a higher income perspective. Okay. Some more potential planning opportunities for higher long-term gains rates. If the step up in basis at death is retained, you may want to consider holding assets until death. But if the step up in basis at death is repealed in favor of a forced sale event, then you might want to consider selling and realizing some gains during your life. So if this is happening, if this gets repealed, you may want to start looking at harvesting those gains today and paying taxes today so that there's no forced sale event later, which could be just a huge mess for whoever inherits your assets later. Okay. So here are some potential planning opportunities for the flat retirement tax credit. Okay. So remember we talked about there is a 26% flat retirement planning tax credit. So this is going to flip things around based on what we currently are normally recommending, or you probably have as common sense. So if this happens, a higher earner would be a lot better off contributing to a Roth account now than a traditional 401k. Because remember, your maximum deduction is going to be 26% of your contribution. And if your tax rate is 39.6 or anything above 26, you're not only going to have to lose that deduction today and pay extra tax, but then you're also going to have to pay tax later on the 401k or IRA distribution as it comes out in the future. Okay, so that could be very bad. If your marginal tax rate is higher than 26%, you may be much better off to pay taxes now and use the after-tax fund to contribute to a Roth 401k account, or use contributing to an after-tax 401k and utilizing what's called a mega Roth contribution strategy, and then convert to Roth later. Okay, if you're not sure what that is, again, reach out. We can possibly help you out with this. But if you have a lower income, it is much better for you now, if this passes, to contribute to a 401k or IRA than in a Roth account. Okay, so this is something that's going to totally flip things on its head. And most of you, there's a high potential that if you're in a low tax bracket, you're thinking about contributing to a Roth account if you're in let's say a 12% tax bracket or below, or even a 22% or below. But if you're going to get a flat 26% deduction, well, it makes more sense for you to go to a traditional account potentially if this passes than it does to go to a Roth account. From a tax perspective, you may simply just want to be in a Roth account anyways and just not have to deal with this in the future, because it seems to be every few years that we go through a huge tax policy change, and this is probably not going to stop anytime soon, by the way. But this is something that somebody asked, what is considered lower income? So anything below 26% is considered lower income for your marginal tax rate. So 22% right now for a, let me get my little book here. So current rates here. And this is, I'm pulling this right out of our 2021 important numbers, okay? So if you haven't got that, folks, search the group here for 2021 important numbers. I put a chart in there you can download to get this. But if you are making anywhere below $172,000, then that's in a 22% bracket as a married filing joint couple. If you're a single filer below $86,375, then you are in the 22%. The 24% currently is up to $329,000 for a joint couple. And for a single person, it's $164,925. So joint is $329,850. Single is $164,925. So depending where the brackets end up, if you're below those amounts, you're going to have more of a benefit to contribute pre-tax and get the 26% deduction than going straight to Roth accounts. So this stuff, this is going to be potentially a huge change, just like the Tax Cut and Jobs Act a few years ago was a big change. We'll see what happens. I'm not really sure where it's going to go, but these are things I want you to be aware of so you can be thinking about your planning, okay? All right, and then just to kind of summarize a couple more things here, some potential considerations related to the Biden tax change. If you are if you're going to be in a higher tax bracket, potentially accelerate income and defer capital loss. If you're going to be in a higher long-term capital gain bracket, you really want to carefully manage and spread that long-term gain over years. And a difference in tax rates you're looking at potentially 23.8 and to 43.4. So if you are in this high income area, this is a massive increase. We're talking, double essentially on your taxes for long-term capital gains if you're above those high income amounts. And then if you are contributing to a retirement and this flat retirement savings tax credit comes through at 26%, then you actually want to possibly do a complete reversal of the current tax brackets. So you want to, go to Roth accounts if you're a higher earner. They're going to be better for higher earners. And then pre-tax accounts are going to be better for lower earners. So anything below 26% marginal rate, okay, is considered low income. Or I wouldn't say it's considered low income, but it's considered a lower earner in reference to this tax plan, okay? All right, and then the last thing here is the loss of step-up basis. And so you really want to look at carefully planning to spread capital gains during your life versus potentially having a massive capital gain for whoever inherits those assets, after your death, which could be a very, very ugly situation. Okay. So I think that's pretty much what I have for you today. So let's go to some questions here and talk about what questions you have and see if I can answer them. Okay. First of all, please let me know if this was useful. I'd love to hear if this was useful, if you found this useful and you like stuff like this because, it takes some time to prepare. I enjoy it, but I also don't want to do things that you don't find interesting. So let's see here. Okay. So does this tax plan provide any revenue to address the future Social Security trust fund shortfalls? Yes. That's really what it's about. I mean, I don't really think it's going to make a huge difference, by the way. It's going to extend it only a couple of years. So if you think about it, if 1% of people are earning above $400,000, per year, and the new Social Security tax, that donut hole where it's going to increase after $400,000, well, then there's about 1% of people that are going to pay into that. Okay, so is it going to provide revenue? Yes, but is it going to address this Social Security trust fund shortfalls? No, it's not going to address that. So I don't think it's really going to fix that. It may extend it a few more years, but it's not going to completely fix it. To fix that, we really need to do some other things, like considering actually increasing the Social Security tax is one. From one projection I saw, showed that if we increased it over a number of years from where it's at now by about 1.8%, we can get that trust fund to last another 75 years at its current payout rate. So that's one thing we can look at. They can also look at privatizing the management of the funds that are used in the funds that are in the Social Security Trust Fund. That could be one way to do it because the government can't really get into any sort of high risk investments. So they're using fixed income investments, which we know are not going to be paying a whole lot going into the future with interest rates basically going to zero. And then another thing would be to consider things like deferring the full retirement age, right, to making that a little bit later. That's been done in the past, so I don't see that as something that's impossible either. I believe there'd probably be a combination of things, but I don't know. Very few politicians are going to get elected based on saying they're going to increase taxes. Biden did it, by the way. He told people all along he's going to increase taxes, and people voted for him. So, not saying it's impossible, but I think they have an opportunity here to really fix this. And I think that would be a better way to go, honestly, would be to focus on that Social Security Trust Fund versus some of these other things that they want to do. It's just not really going to make a big difference. But, that's my opinion. So, good question, though. Let's see here. How would you determine a cost basis on a 401k? We all started out at zero. there's your answer, right? Your 401k, you're going to have a cost basis of zero, so that's just what it is. It's going to be fully taxable at that point. And so if you look at your home, your cost basis is the amount you paid plus any enhancements you've made, right? That on top of that. With rental property, you've most likely depreciated that over time as well. And so your cost basis is going to be even lower. But you answered your own question here. For some reason, the names aren't coming in, but so good question though. But yeah, we all started at zero. That's exactly right. Let's see here. So it has the gift limit amount per year changing. So I'm assuming you mean the $15,000 per year per person, per individual, I should say. So no, that's nothing in there as far as what I saw. So I don't think that's changing at all. So that might be a great way to start getting rid of some assets if you are expecting to be somebody who could be affected by this potential tax change. Okay. Good question though. All right. Is this for tax year 2020 or next year? Well, 2020 is already gone. I'm assuming you meant 2021. From what I've been researching, and again, these are people that are much more into the tax space than I am, high-level CPAs and things like that. They believe there's about a 20% chance that this could be retroactive for 2021. So more than likely, it's not going to happen in 2021, which is why I'm recommending accelerating income potentially if you are a high income earner, so you can take advantage of 2020 rates before this goes into place, because I have a strong feeling by 2022, it will be in effect if they do push this through. Okay, good question. All right. So will a trust eliminate the tax basis issue on your home for your survivor? So this is an area where it can get legal, but there are trusts that can potentially help with this. Okay, so there's going to be a lot of opportunity for estate planning here, and so there are different types of trusts that could potentially help with the situation that you want to look into. So if you're somebody that could be affected by this, you may want to set up an appointment with your advisor and your estate planning attorney to get this all worked out, because there definitely could be some opportunities there for some trust planning. All right. Let's see here. All right. What about the interest rates that are now 3%? What if they are backed up to 12%? Would that eat up the $15,000 tax credit real quick? Well, okay, yeah. But I'm assuming you mean on home purchases and mortgage loans. But the Fed has already made it very clear they're not going to be increasing rates for at least the next few years. So at least until the economy recovers is what they said. So I'm not too worried about anything going back up to 12%, because that would just completely crash everything. I don't think that's going to happen for a very long time. So I think this is going to be a great opportunity for somebody who's in a potential for a first-time home buyer purchase. I would definitely recommend that you get ready to take advantage of this if you have somebody in this case. So good. Okay, wonderful. Thank you guys for the feedback. I appreciate it. Wonderful. Okay, good. So a lot of positive comments. Hey, I appreciate you guys watching. It really means a lot to me that you take the time to watch, and that you will spend the time to listen to me. I try to do my best to provide value for you and bring you things that I think are going to be useful, and then also those of you that come in and ask questions, and so it gives me ideas on how I can help you out. So I'm going to leave my link here. If you want to set up a call to discuss, if you want to look at getting some help managing your tax journey, of where to put money away each year, should you be looking at things like Roth conversions? If you're getting close to retirement and you want help with distributions, what accounts should we be taking it out of each year? How do we prepare for the future? We'd love to help you out with that. This is what we do. And I think this is where we're really going to be focusing on for a lot of our clients, is helping you manage the tax journey. We offer a complimentary consultation, no cost at all. And I'm doing all of them right now. So you will not be speaking to anybody else at this point, but you may be in the future. I'm looking to hire some help here pretty soon. But you can go to keepitsimplefinancial.com/talk. Once again, that's keepitsimplefinancial.com/talk if you would like to set up a call to discuss. I will also put my link in the comments down below. And then after this workshop is over, I'm going to post this on my Facebook page, which is not inside this group. So if you're a member over there, I appreciate if you shared it, and also send it out by email. If you can share it with people, I think this will be useful for any of your friends or family members to really learn about what's coming, because this is going to affect almost everybody, in some ways good, some ways really bad, in some ways, especially for those of you that own homes or any sort of assets that are going to be inherited potentially one day. You really want to be planning for this stuff, okay? So again, once my website is at keepitsimplefinancial.com/talk. And if there is not any other questions, which I don't see, I will wish you a wonderful Super Bowl. I told you I finished early. Super Bowl starts in about 30 minutes. Have a great day. Enjoy the game, guys. And let me know in the comments as well who you're going to be rooting for, okay? I got the Bucks. I was just in Florida a couple months ago. Really beautiful place. So I'm going to go for the Bucks. So we'll see what happens, right? Appreciate you guys. Have a great afternoon, and we'll see you next time, okay? Bye-bye now.